Stock staging a comeback in 2019, now up 10% from its Christmas Eve low after a rough quarter that sent the market careening in December. That sell-off also brought with it a big valuation compression. Dom Chu's back at headquarters with more on what stocks are worth now. Hey, Dom.
Well, Melissa, it's been a pretty strong rally for stocks since that market bottom and the market melees on Christmas Eve. And as a result, stock market valuations have also staged a bit of a comeback from depressed levels with the overall market. So we took a look at forward price to earnings ratios. Now, in late January of last year, the broader S&P 500 traded at around 18.7 times expected earnings. Today, that number is closer to around 14.9 times. That's around a 20% drawdown from peak valuations inside of the last year. Now, from a valuation perspective, the sector that got absolutely crushed the hardest was energy, which traded with a forward PE of around 26.7 in early January last year. It currently trades at around 15.6 times. That's a 42% drop in relative valuations. Industrials traded at a forward PE of 20 in mid-January last year. Now it's 14. That's a 30% drop. Now, even a blue chip component, say like a Boeing, which admittedly has become one of those stocks tied more closely to U.S.-China trade talks and sentiment, it traded at nearly 29 times forward earnings a year ago and now trades at just below 19 times, a 34% drop in relative valuations. Now, Melissa, it is a combination for this entire story, no matter what stock or sector, of lower prices and, of course, lower profit estimates. Now, will traders find value picks, or is more valuation compression still to come? Big question for traders. Back over to you.
All right, Dom. Thank you, Dom Chu. In the newsroom, I don't know what metrics you guys have. I mean, Dom was mentioning the drop in valuations, but I think it's also important to think about it in terms of relative to itself historically, right?
Yeah,
Boeing relative to itself historically.
And I think Boeing on a free cash flow yield, even relative to itself, got really crazy cheap. I think if you look at the NASDAQ, it was, it's at the lows, we were somewhere around 20 times, which is an extraordinary number for the growth you're getting in the NASDAQ. I don't think there's any question that we've seen valuations get to a level that's attractive. And I think even after you've gotten back to, a 10% rally, you can make an argument here. But we need to wait and get guidance from companies. We need fresh guidance. I still don't believe we get 7% earnings growth on the S&P in 2019.
Yeah, I think that's the key. And we just talked about Microsoft. So we have an S&P that's trading 14 times. We have Microsoft trading about 23 times, where EPS growth is expected to massively decelerate. If you have a full year 2019 cut, then that stock becomes a lot more expensive really quickly. So my view, very simply, is in some of these names that are trading rich to the market, I think you do have to wait for 2019 guidance.
Well, for me, it's more of a value versus momentum play here, right? So we might be in a period where value is starting to take over. So you look at something like IWD, which is the value ETF. That might be something that outperforms something like Dan's MAGA, which tend to be a lot more momentum names. You get these cycles over 5-year periods. So if I'm looking for value, that's what I would do.
I look back, and exactly a month ago, give or take, call it December 12th. I was just looking at my notes, got them right here.
Yeah.
We had a little thing we were talking about safe buys because of what we were seeing in the marketplace. And I looked for names that had huge contraction. They absolutely, you look at their PE levels or where they came from, and United Rentals, for instance, nearly a $200 stock, gets beat up.
Yeah.
And you start looking at Mohawk, another one of these names that was sky high and gets beat up. Single-digit PEs, but I'll give you one other that seems to have gotten lost somehow, NVIDIA. This is a $292 stock that everybody loved when it was a 90 PE, it seemed. And then suddenly it gets down to 130 and everybody hates it. Even now at 142, trading at 18 times. They have growth. I think that they're going to still be able to report growth. So I think some of those other two names, even if they are just even with their earnings and show no growth, they're trading at single-digit PEs. I think there are opportunities out there still in the market.
I just think a name like NVIDIA is a bit dangerous, and I'll tell you why. Their growth has massively decelerated. EPS growth is expected to be flat. Sales growth is expected to be single digits. When people were paying 90 times for that in 2016, 17,
they were paying it for gaming.
They were doing it last year, too, though. This is last year.
I know, and I don't know, listen, it was a great trade, but these are also very cyclical stories. So if you're hitting the wrong end of the cycle, it becomes a huge value
But those are the kind of names, though, right? I mean, you're looking for the names that absolutely, I mean, Tim talked about it earlier. He talked about the semis and how he thinks they're maybe starting to turn. He's probably right. But, you look at that name. When it was trading at 90 times, everybody loved it.
That's fair.
And now that it's trading 18 times,
at
it's
90
hard
times,
to find
they also
buyers.
thought that crypto was a growth market.
Right. Although,
that's
and there
going
was less
away.
competition in gaming.
Yeah,
Right, it is less competition.
There's been a bit of a hangover there. The cyclicality of this conversation is obviously critical because, to me, FedEx is the ultimate cheap stock and arguably one of the most cyclical companies in the world, but trades at a trough multiple. Bought some FedEx over the last week, and I feel comfortable with that name. That's a great company that, to me, has been pushed around by expectations of global growth. Dan shakes his head, dude. Stay in your lane, bro.
It's not a MAGA.
Yeah.
If it's not MAGA, it doesn't matter.
Basically, he shakes his head the whole
This is
show.
true.
And whenever
I
everybody-
just want to make one point. You know, no one thought that Apple was going to have the dump that it did from
Yeah.
230 down to here, and it did it for fundamental reasons, and then it did it for macro reasons. And one of the reasons why, if you lose Microsoft or any of those mega caps that are $800 billion in market cap, then this market, this is my point for months now, then this market has real problems. It's fallen and it can't get up.
If you are wondering
Heard
where to
that.
find value in today's market, there's no better person to point you in the right direction than the Dean of Valuation. Aswath Damodaran is a finance professor at NYU's Stern School of Business. He joins us now from San Diego. Aswath, great to see you. We've been having a fierce debate on this desk in terms of NVIDIA. I know that's an area that you like. But overall in the markets, what sort of valuation metrics do you use? Because so many people come on and say PEs have been compressed, forward PEs have been compressed. What do you look at?
I look at a forward-looking number called the equity risk premium. Basically, I back out from stock prices and cash flows what investors are expecting to make. And at the end of 2018, that number was close to 6%. There have been only 3 years in the last 55 where you've had a higher number. One was in 1979, the other was at the end of 2008, and the third was in 2011. If you look at the cash flows and the level of interest rates today, stocks look more likely to be undervalued than overvalued. That said, though, I think the big concern for the coming year is going to be expected growth. So the earnings reports for the next 2 quarters are going to be key in whether stocks can sustain themselves. I think if you can go through the first 2 quarters without major shocks to earnings, I think the market is poised to recover.
So basically, even though the market seems, according to these metrics, like the market is undervalued or more likely to be undervalued than overvalued or fairly valued, it's still a wait-and-see market for the first half of the year.
Because I think growth has come down substantially. I mean, expectations have come down so much over the last year. The question is whether we've adjusted enough or whether there's more to go. There might be more shocks along the way that bring growth down even further. But at the moment, given what people are expecting, and even in terms of lower growth, I'd be more likely to buy stocks and sell them.
Okay, be the tiebreaker on our debate on NVIDIA and whether or not it's value in this market. And it doesn't have to be a comment on this individual stock, but I know that you like tech stocks in general and see value there.
I did buy NVIDIA at the end of last year because it's a stock that's been on my radar for a long time, but not at the prices it was trading at. My limit buy came in at 145. I'm still waiting to get back to 145. I might never get there. But I like the company. I mean, I think there is a real chance growth could drop off next year, but I think long term I would still buy the growth in that stock at the prices that you get them for today. I also like Boeing. I mean, I think it's a stock that got punished for all the wrong reasons when the China proms popped up. But, you know, let's face it, you can substitute for Apple. You can't easily substitute for Boeing. So I don't think you can tar all these companies which have China exposures with the same brush.
So the 2 broad categories of value in this market, in your view, Aswath, are beaten up tech stocks and companies exposed to China. And what really caught my attention is that you even like General Electric, which is sort of, I mean, it has China exposure, but it's also a story in and of itself in terms of being a turnaround story.
Yeah, GE has been so beaten up that at this stage, if the management can chew gum and walk at the same time, people are going to think they're geniuses. So I think it's a stock that I'm buying because people just don't expect it to do much. But I think it still has some solid businesses that if it plays its cards right, I think you could see a significant recovery in the stock.
But Professor, is it cheap? Is there value there? I've tried to make the argument that there's a sum of the parts argument. So is that what you want to do, or do you just think it's about chewing gum and walking?
I think, in a sense, the quality of the management is in how easily they can disentangle the parts. So on a sum of the parts basis, GE looks undervalued. But it's very difficult to break up the parts because they're all connected to each other. You need a pretty solid management team to be able to separate the parts and to be able to get the best prices you can for each part. That is going to be the test for management, is whether they can do that. This is not a turnaround story. This is a story of disentangling a company and selling off its pieces for the best prices they can get.
Professor, thanks so much for joining us. Always a pleasure speaking with you.
Thank
Aswath
you.
Damodaran of NYU. Next time, if I see Larry Culp, I'll see if he can walk and chew gum at the same time. I didn't know that
bet
was
he
such a
can.
key indicator.
I bet he
Where
can.
would you, do you agree with any of the professor's picks in terms of value?
Sure. I mean, NVIDIA, I just want to make one more point here, guys.
NVIDIA,
Just like it
yeah.
overshot to the upside for like year after year for 3 years, there's a good chance, even though it's been cut in half off of last year's highs, that it overshoot to the downside. And so
Has it already overshot? Or
well, but we don't know. I mean, so the point is that it went up 1,000%, and now it's down, 50%. Could it go down 70%? I don't know. I think it's really hard to attach some kind of funky valuation metric to just to assign to what your view is about it. So I think that stocks like this will overshoot to the downside. We saw it in names like Square, where sentiment just got overly optimistic.